Let's welcome on board Rakshit Ranjan of Marcellus Investment Managers as well. Rakshit, hi, let's begin by talking about the defense space itself. We all know the kind of potential it has, the opportunity size, etc. But do you really think, A, it will materialize? And secondly, is it not priced in already?
Yeah, I think the opportunity is good. As the previous speaker, the management team was talking about it in terms of why the opportunity is growing bigger. So opportunity is good. Whether it is priced in or not, that is a company-specific call that we have to take. There are certain companies where this is a flash in the pan in terms of ability to capitalize on the opportunity, for which you're right, it might be priced in, but there could also be several other opportunities from a bottom-up perspective to invest in companies where this is an ongoing structural a sort of tailwind rather than a flash in the pan. So stock specific wise, perhaps you'll have to go, but the opportunity is there, and in some areas it must be getting priced in. Yeah.
So talk to us about some of those opportunities. Are they emerging more on the manufacturing side, the entire EMS vertical, defense-wise as well? Is it a specific PSU name that you like? Is it the naval-based companies? Any way you can help us dissect in terms of the entire sector where the value is?
Yeah, I mean, we are looking at a few areas ourselves, not yet, I would say, fully convinced on any specific name that we can talk about, but not so much the PSUs. Elsewhere in the sector, there are some possibilities of finding an opportunity here.
Okay, Rakshit, that point is taken. Let's also talk about financials, because that, of course, is the biggest pie right now. What's your take regarding HDFC Bank? Because I remember speaking with Saurabh many times, and he's been a perennial bull when it comes to the likes of ICICI Bank, HDFC Bank, etc. Do you think it will re-rate once this event of merger is past us?
Yeah, no, I mean, to begin with, we have HDFC Bank as a stock in our portfolios, for our clients' portfolios, even in our family, as a disclaimer. So we are quite positive on the prospects of the bank after the merger, and there's significant synergies. At the very least, I would say the biggest low-hanging fruit that the bank has after this merger is sort of unlocking of resources which were locked up to drive a short tenure book. Now, once the tenure of the book becomes longer instead of the short tenure that it had prior to the merger, immediately the runoffs become slower, and the disbursements to grow at a certain rate of loan book, they have to be a little slower rate of disbursements for the same run rate of loan book growth. So that unlocks a lot of opportunity in terms of redeploying resources in more productive areas than what was previously possible before a massive loan book oriented towards long tenure home loans was available to HDFC Bank. In addition to that, there are massive cross-sell, upsell opportunities from the broader group that will act as synergies. So we are actually quite positive. Yes, the recent quarters deposit growth was a little more muted, but other than that, I think the loan book growth was pretty robust, pretty strong, particularly retail and SME. And going forward over the next few quarters, as the benefits of the merger come out, I think you should see a far stronger institution here than what was the case prior to this merger.
Rakshit, curious to know, what are you making of the two-wheeler space now that iShares' dominance is going to get challenged by Bajaj as well as Hero?
Yeah, no, it's a very interesting space. I would say at the moment, as far as we are concerned, we're working on it with an open mind to understand in which direction this goes. But this is a competitive intensity ramp up that you shouldn't ignore as an investor. iShares was doing exceptionally well, but what's happening with particularly Hero, the Harley-Davidson angle, and overall competitive intensity rising in the last couple of months, it's something not worth ignoring. But yeah, we are working on it. as of now, not made up our minds in which direction, who will be the winner eventually from this.
Right. The other one I also wanted to talk about is as to, Maruti's now entry into the SUV or MPV segment, call it what you may, with the latest Invicto launch. And then, of course, Tata Motors, given the kind of stock performance that it's been having, and not just the domestic business, but globally as well, JLR sales are on the uptake. Within the PV space and the four-wheeler space, what is it that you're liking?
In the passenger vehicle space, in fact, four-wheeler space, we don't have any of these stocks under our radar, precisely for a simple reason that they all see their phases of good products, good designs coming out, but the follow-through is not so great. And end of the day, when you consider, say, pricing power of one four-wheel manufacturer versus another four-wheeler manufacturer, the pricing power, it tends to exist for relatively shorter pockets of time, rather than we having been convinced that there is any player here where if its competitor, let's say, offers a 10% extra discount to the dealers or 10% extra margin to the dealers, then this particular player will not be affected adversely on either profitability or market share. If you go by the pricing power definition 101 like that, where, for instance, just to give you an example, some of our portfolio companies like to a Tanishq, it doesn't matter as much if some of their competitors are offering lower making charges, but to some of the four-wheeler owners that you talked about, it matters a lot if their like-for-like competitors are offering say 10% extra dealer discounts, just to take an example, and hence. I think we've tried to stay away from the four-wheeler space in most of the portfolios, barring I would say Maruti, which we've had under coverage, which we still do have under coverage, but we don't have the broader space too much of interest there.
What's your take regarding the entire NBFC and home financing names? Because I was just going through ACP portfolio, quite a few financiers in terms of Aavas, Home First, Chola Investment, and even otherwise, quite a few names from that particular vertical. Explain to us the rationale and why, specifically these names and not the rest, and what about the microfinance angle, because that seems to be coming on investors' radar as well.
Yes, no, this is a very exciting space, and as you rightly picked up, we have quite a few companies from this space under our coverage. Right from the top, I would say the Bajaj Finance, the largest NBFC, down to some of the other names. We have exposure in our portfolios, our clients' portfolios, our families' portfolios, etc. The attraction here is that to begin with, financialization of the whole economy in India is creating informal to formal shift even at a small ticket unsecured loan book level, and you go higher up from there in terms of the ticket sizes, in terms of the profile of the borrowers, etc. There are several pockets where the banking infrastructure doesn't easily make business viability, which is where the NBFCs, they come in and offer greater value add to the borrowers through direct sales or through intermediaries, etc. And some of these NBFCs, particularly the ones that we have under our coverage and in our portfolios, they have developed an understanding of their client base from a first principles perspective, which is not based only on bureau data. They've got their own approach towards understanding which client to lend to. Take, for instance, Bajaj Finance as the best and the biggest example of an NBFC which adds value to borrowers, to intermediaries, to shareholders eventually. So that's really the opportunity size here, differentiated offering versus banks.
Sure, differentiated offerings is what you're going for, and differentiated offerings even in IT, because I had a specific question. I see Tata Elxsi as well as L&T Tech in your portfolio, and there was a very interesting note from JP Morgan saying that the ER&D sector is set for a de-rating, potential downside of anywhere between 40 to 50%. You're on the completely other side of the spectrum.
We take longer term views. We don't take sort of 1 quarter, 2 quarter calls. When you look at the longer term view of how ER&D IT services is likely to evolve, the demand side is shooting through the roof as the way to run a business, the way to run infrastructure across various aspects of the economy of various countries around the world. It changes. It becomes more digital, becomes more tech oriented, whether it be auto, whether it be various other kinds of sectors. And hence the demand side is shooting through the roof. There aren't too many companies with scalable, high quality manpower to create solutions and provide them to cater to this demand. And we do believe that the two names you took, which are in our portfolios and in our coverage, they add far more value than many of their competitors. And hence, yeah, from a long-term perspective, we are quite comfortable holding on to them.